Hello and welcome to the Tax Roundup for May, and the federal budget is coming up this month. If you're already on Knowledge Shop's database, then you can access a copy of our comprehensive budget summary the day after the budget. This month in the Tax Roundup, we're exploring two important cases. The first deals with rollover relief on a marriage breakdown and reverses the position previously held by the federal court. The second case looks at the derivation of income in a professional services firm, which is quite an interesting case. But first up, Michael is going to take you through the new Law Companion Guide released dealing with those 1 July 2018 property development changes where the vendor will be paying the GST. Across to you, Michael.
Now, many people would understand and be aware that there's some new GST rules due to start on 1 July 2018, which basically ensures that purchasers of certain property are required to pay a GST amount to the ATO, rather than paying it to the vendor, who would then pay the GST on their activity statement. Now, those rules are basically ready to go, due to start, as I say, from 1 July 2018. But prior to that start date, the ATO has started to release some guidance around how those rules will actually operate in practice. And one of the pieces of that guidance is this Law Companion Ruling 2018/D1. Only in draft form at the moment, but does give a view, or the Commissioner's view, on how these rules will actually apply. Just a couple of things to take out of that guidance at this stage. Firstly, remember that these new rules are really intended to apply in situations where someone is buying new residential premises, so newly developed houses or units, etc., or in some cases, newly subdivided residential land or lots. And they're the two main categories where these new rules could kick in. And what they do is they make the purchaser responsible for paying an amount to the Commissioner in respect of the GST component. Now, in terms of how much has to get paid to the ATO, this ruling basically explains the different situations and what GST amounts would be payable. In the base case, where it's a normal taxable supply of residential property, for example, and the parties aren't related to each other and the margin scheme is not being used, well, the purchaser just has to pay 1/11 of the contract price to the ATO. If the parties have agreed to use the margin scheme and the margin scheme is being used in relation to the sale, well, it's a little bit different. What the ATO says in that case is that you use 7% of the sale price instead. So 7%, I don't know how they've come up with that number, but obviously is less than what 1/11 would be. It may end up being more than the actual GST amount payable by the vendor, but they'll just recover the difference from the ATO later on. Where the parties to the transaction are associates, then it's basically a market value rule. The purchaser needs to pay 1/10 or 10% of the GST exclusive market value of the property to the ATO under these new rules. So the amount that gets paid to the ATO will very much depend on the situation and the relationship between the parties and whether the margin scheme is being used. Now, the other thing that the ATO makes the point of in this ruling is timing. The deadline for paying the amount to the ATO is the day on which consideration is first paid for the purchase of that property. Now, there's an exception to that, which is for genuine deposits. So where a genuine security deposit has been paid on entering into a contract, that shouldn't, in most cases, cause the purchaser to have to pay amounts to the ATO. But once settlement occurs, then that liability would typically be triggered, even if the purchase price is to be paid in instalments, because it's the first time that consideration is first paid for the purchase of the property, except where it's a genuine deposit. So purchasers will need to make sure that there's cash flow there, that they've got the cash to actually pay the amount to the ATO, even if the purchase price itself will be spread out over a period of time. So new rules due to begin. This is something that you'll need to keep in the back of your mind if you're involved with clients who are in the property industry, buying or selling, then certainly they will need to be on top of these rules, and you'll need to get your head around these rules prior to and around the time they start. For everyone else, if this is something that just is something that comes up occasionally, again, need to be aware that this is coming, because don't always assume that someone else has got this under control. You would hope that conveyancers and solicitors would be picking up on this issue, but particularly as the rules are new and over that initial period, I wouldn't assume that that's the case. Don't assume that someone else has figured this out already. You may need to step in and make sure that this is being looked at, particularly if you're helping a purchaser buying property, because they're the one who's really exposed under these new rules. So 1 July 2018 start date. This ruling is only in draft form. We'll keep you up to date when a final ruling is released.
Now we're going to look at that case that deals with the deviation of income from a professional services firm, Hart versus the Commissioner of Taxation.
Now we've got another case that's come out of the full federal court this month, which is the Hart decision. This case pretty loosely relates to diversion of income away from a professional firm and how and where that income should be taxed. Now, it's a very convoluted set of facts. This taxpayer was basically a solicitor, a lawyer working in a law firm. They didn't hold their equity stake in the firm personally. That stake was held by a family trust. And basically what the taxpayer had done was entered into this convoluted set of arrangements to basically avoid paying tax personally on most of the profits that were flowing out of the firm into their family trust. In the years in question, and this is going back around 10 years, the taxpayer, the solicitor, was only declaring about $100 of taxable income in their tax return. But the share of profits that was flowing out of the firm into their family trust was closer to and above $200,000 for the year. Now, basically what had happened was that the distribution was going to the family trust. It was then finding its way through a series of other trusts and companies to an entity that had some carried forward tax losses. Tax losses were being absorbed. And basically what was happening at the final step was that funds, well, the taxpayer argued that the funds were being lent to them. So they were receiving the funds, but they were receiving in the form of a loan, a non-taxable loan, rather than a taxable salary or a taxable distribution. And the Commissioner took issue with this and said, well, no, we think that those funds that have found their way into your hands, the hands of your family, should actually be accessible to you. And the Commissioner attacked this under the trust assessment provisions, but also under the general anti-avoidance provisions in Part 4A. Now, this all found its way through to the full federal court. And the full federal court, basically in a nutshell, said that this money should be taxed. It should be taxed in the hands of the taxpayer. Now, a couple of things that were quite interesting coming out of this case. The first one is that the full federal court said they don't really believe that there was actually a loan to the taxpayer. They looked at the evidence that the taxpayer was able to produce, and basically said that from full federal court's point of view, they didn't think that the arrangement that was put in place actually amounted to a loan. And that's an important point because we've seen a few of these recently, a few of these cases over the last couple of months, but also going back over a couple of years, where the Commissioner and the courts have said that just because you've called something a loan in your accounts doesn't make it a loan. You need to look at the substance of the arrangement. In this case, the substance of the arrangement suggested that this was not in fact a loan. Well, what was it? And what was the tax treatment of these funds? Well, the full federal court said, well, the Commissioner has made some arguments and suggested that there's a couple of different ways under the trust rules that these funds could be taxed in the hands of the taxpayer. The full federal court said, well, that may well be possible, but we're going to go a step further than that. In the full federal court's point of view, basically they said that these payments were simply ordinary income. You didn't even have to look at the trust rules. What the court found was that you've got these series of payments, and in some cases we had a regular series of payments being made on a periodic basis. We had payments that when you looked at the description of the amounts in bank records, bank account records, they used the word pay. You had this person who was a lawyer working in the firm, providing legal services to clients, directly involved in the provision of the services and the derivation of fees for the practice, but only reporting $100 of income in their tax return. And the court also said that there was no other obvious source of income. The taxpayer couldn't show any other source of income that was being used to fund their daily living expenses. Now, looking back through old case law, what the court said was, well, when you add all those things together, this looks very much like ordinary income. This is someone who's doing some work, they're receiving money for it, they're receiving it on a regular basis, it's being used to pay their daily living expenses. Add all that up and you get ordinary income. So the full federal court said that some of these payments were simply ordinary income taxed on revenue account. The fact that the money in the accounting records looked like it had been funneled through some other entities, at the end of the day, the substance was this was ordinary income. Now, another thing that comes out of this is, again, quality and consistency of evidence. One of the bits of evidence that the court looked at was the taxpayer and their spouse wanted to buy some rental properties. So they applied to the bank for a loan to buy the rental properties. And as part of that process, the bank asked them, well, what is your income? Interestingly, on the correspondence and the application forms to the bank, the taxpayer said, well, my income is around $200,000 a year. So the court said, well, you've told the bank that your income is $200,000 a year. The commissioner is trying to assess you on $200,000 for that year. We have no objection with that. We think the commissioner is right. And the fact that you're telling the bank that that's your income suggests that maybe it is really your income. So the federal court said, it's your income. The fact that you tried to, I guess, avoid paying tax on that, in this case, was not effective. Now, the court also looked at possible Part 4A issue and basically said that the commissioner was correct in applying Part 4A. We won't go into the details of the Part 4A analysis, but again, interesting to point out a point out of that, which is that the taxpayer had said, well, the dominant purpose of this arrangement was not to obtain a tax benefit to avoid paying tax. It was things like asset protection. And the court said, well, that may be the case, but you haven't actually been able to justify what asset protection you got out of this arrangement. So simply throwing out an argument that there's another reason for doing this is not enough unless you can demonstrate that that is a genuine reason and that you did actually get or intended to get that benefit out of the arrangement. So there's a lot to unpack here, and if we think about this in the broader context of what's happening at the moment, you might recall that the ATO had some guidance over the last couple of years looking at allocation of profits from professional services firms and saying that Part 4A could apply if people were too aggressive in the way that they were splitting up their share of profit or income from a professional services firm. The ATO has recently suspended that guidance and said they're concerned about some of the arrangements that people are entering into. And I think this case shows that maybe the ATO is possibly heading down the right path in terms of what people are doing, the arrangements that people are putting in place to try and divert income from a professional services practice and have it taxed in some other way rather than personally in the hands of the person who's actually doing some of the work. So this is an area to be really careful about. Also have a think about loan arrangements, money that's drip feeding out of a company or a trust on a regular basis. Is it really a loan? And are you able to justify that that is a loan and not just ordinary income? These are big issues and there's a lot to unpack in this case, and I'm sure we'll see a bit more coming out of this. But worth bearing in mind, yes, this was a convoluted arrangement, but take into account some of those basic principles that flow out of this. And you see, this is dangerous territory where those people are trying to divert income that would otherwise be taxed in the hands of the person doing the work.
Now we'll explore that CGT rollover relief for marriage breakdown case, Alison and Antonov versus Santini.
And we're looking this month at the Santini case, which has gone to the next level. This is actually a case we've talked about before. Previously, what the primary judge had held in another version of this case was that marriage breakdown rollover relief was available for the transfer of some shares that took place. Now the case has moved on to the full federal court, and the full federal court has basically taken the completely opposite view and said that rollover relief was not available. Let's just have a look at what happened in this case and then kind of work through the tax rules. Basically what happened was there was a marriage breakdown scenario and a family court order was made indicating that some shares held by a trust were to be transferred to one of the former spouses, the ex-wife in this case. Now, what happened in that case was the shares were not actually transferred to the former spouse, the individual. The former spouse said, well, rather than transferring those shares to me, I'd like you to transfer them to an entity controlled by me. And in the end, that's what happened. Now, when the primary judge looked at this, what the judge said was, well, even though there wasn't a physical transfer of the shares to that individual, when the family court order was made, it actually caused a change in beneficial ownership of the shares. That triggered a CGT event, which meant that rollover relief could apply for that transfer. Now, the full federal court has looked at this again and said that when the family court order was made, it did not trigger a CGT event. There was no CGT event until the shares were actually transferred to this entity that was controlled by the former spouse. Now, if we then have a look at what the legislation says, there's marriage breakdown or relationship breakdown rollover relief that can apply when an asset is transferred by one former spouse to the other former spouse. Rollover relief can also apply when assets are transferred by a trust or a company to one of the former spouses personally. So you can have assets come out of an entity, like a trust or a company, but they need to find their way into the hands of one of the individuals, one of the spouses or former spouses. In this case, what the full federal court was saying was that these shares were not transferred to the individual. They were transferred to another entity at the direction of the individual, but not to the individual. The individual was not the transferee. So because of that, the provisions dealing with rollover relief were not satisfied. Now, when the original decision came out, there were suggestions that that decision had maybe broadened the scope of the rollover relief, and it meant that maybe there's a bit more flexibility in how these things could be structured to still take advantage of the CGT rollover. What the full federal court decision suggests is maybe that's not the case at all. Maybe it is a fairly narrow form of rollover relief, and the conditions around accessing that rollover relief are actually quite strict. I guess this is a reminder that whenever you're dealing with any form of rollover relief, regardless of whether it's marriage breakdown rollover relief, some form of rollover relief looking at business restructures, it's important to recognise that there are often some very strict conditions that need to be met. And the arrangement needs to be structured very carefully, and close attention needs to be paid to the exact conditions in the legislation to be able to access that rollover relief. And this is an example of that. So we've got basically a reversal of the previous decision, probably reinforcing maybe what we might have thought previously, that this is a pretty limited form of rollover relief, quite strict conditions. The asset has to basically find its way into the hands of one of the spouses or former spouses for that rollover relief to be available.
And that's the tax roundup for this month. It's only going to get busier from here when we see those trickle-down changes from the budget. If you want to stay on top of change inside your practice, then give Julie a call on 1800 800 232 and see what Knowledge Shop membership has to offer. Talk to you soon.